Hello and welcome back. In this video, we will explore one of the most looked to measures of investment analysis, earnings per share, or EPS. EPS is a valuation ratio that attempts to determine the amount of earnings per share of the company's stock. EPS is an important component of your analysis and, as such, is important for you to fully understand. EPS is a ratio of earnings divided by number of shares. There is an element of ambiguity because there are different types of shares and many types of earnings, so you must understand which types of earnings per share is being discussed. EPS may appear simple, but there are many varieties and you should understand the differences so you can make sound investment decisions. If you pay attention, you may observe the EPS announced by a company may differ significantly from what is reported in the financial statements and in the headlines. Different EPS results can make a stock appear over or undervalued depending on the type of EPS being used. You are going to begin by discussing the varieties of EPS and their pros and cons. By definition, EPS is net income divided by number of shares outstanding. However, due to the art of accounting, both the numerator and the denominator can change depending on how you define earnings and how you define shares outstanding. Let's start with shares outstanding. First, be aware that shares outstanding are not as obvious and simple as they sound. There is what is called primary shares and fully diluted shares. Primary EPS is calculated using the number of shares that have actually been issued and are held by investors. These are the shares currently in the market and being traded. Companies at times issue stock options and exercisable warrants as part of director and executive pay incentive packages. The term diluted EPS refers to the number of shares that would be outstanding if all the warrants, options, etc. that are exercisable were converted into shares at the end of the quarter or year. Since diluted shares are larger number than primary shares, a diluted EPS is preferred because it is a more conservative number if all possible shares issued and outstanding. The number of diluted shares will vary as share prices fluctuate since exercisable options will or will not be exercised based on the prevailing stock price at times and the option becomes exercisable. Yes, it does get confusing, therefore the market assumes the number is fixed as stated in the 10Q or the 10K. Companies report both primary and diluted EPS. Generally, the focus is on the diluted EPS. Just don't assume that this is always the case, do confirm it. Read the footnotes. At times, diluted and primary EPS are the same because the company does not have any options, warrants, or convertible bonds outstanding and exercisable. Companies can discuss either, so you should be certain which is being used. A company can utilize assumptions and accounting policies to make the EPS calculation serve their desired purposes. Also, companies' representatives may talk about a different EPS in their news stories than the EPS reported in the documents filed with the Securities and Exchange Commission. Now again, that's the SEC. You'll hear that a lot. Since EPS is such a driver of stock price valuations, a company may strive to report a high EPS. This would make the stock look undervalued, since the PE multiple would be reduced. Now that's the price to earnings multiple. Always look to the 10Q to what it reports and compare to what you read in other sources. Investigate the reasons for any differences. The answers will likely appear in the footnotes. This is why it is important for you to read carefully and understand what type of earnings are being used in the EPS calculation. The earnings part of the EPS calculation has even more variables. We are going to briefly discuss 5 types of EPS calculations that do vary based on the definition of earnings being used, like I said. Reported EPS is defined as the reported earnings derived from the accounting practices that are footnoted in the company's SEC filings. A company's reported earnings can be managed by management as long as they abide by accepted accounting rules and practices. You may at some time notice that a company's operating income has spiked unusually, due primarily from a one-time gain from the sale of equipment or a business unit. A scenario like this would cause earnings and therefore EPS to spike. Another example might be a company excluding selected expenses at an unusual charge, thus increasing EPS. As you do your research, read the footnotes Read the footnotes in order to decide what factors should be included in normal earnings and make adjustments in your own calculations. Pro forma, or ongoing EPS, is calculated on the stream of earnings from the business's normal primary operations, which can be used to anticipate future EPS. Therefore, it uses a net income basis that excludes anything that is unusual or a one-time event. Exclusions can include a large one-time gain from the sale of equipment, as well as an unusual expense. Unlike reported EPS, pro forma EPS generally excludes some expenses or income that were used in calculating reported earnings. For example, if a company divests a portion of their company, it could restate historical results, deleting sales and profits from that business unit. This enables a comparable comparison to be made. True earnings is another example of pro forma earnings, wherein a company may decide to exclude selected expenses because management concludes the expenses are non-recurring and distort the company's true earnings. The headline EPS is the EPS number that is highlighted in the company's press release and picked up in the media. This EPS may or may not be the pro forma number. In fact, the headline EPS may be different from the EPS estimate endorsed by the company. Typically, you don't know. CNBC and other media do not provide enough information to determine which number is being used. Operating cash flow EPS, sometimes called cash EPS, is operating cash flow divided by diluted shares outstanding. Many feel cash EPS is more important than other EPS numbers because it is a purer, more honest number. Cash EPS may be better for your purposes in making comparisons as a potential investor because operating cash flow cannot be manipulated as easily as net income. Generally, cash is king in determining a company's true financial health. The bottom line of all of this is that there are many types of EPS being used, and you do need to understand what the EPS numbers represent so you can determine whether they are good representations of a company's earnings. You might be considering a stock that has an appealing low price to earnings or PTE, but that ratio may be based on assumptions you find troubling. There's no debating that stocks with high quality earnings are more likely than others to beat the market. The trick is learning how to recognize it. The quantity of earnings received the most media reporting attention. They focus on actual earnings and earnings per share relative to analyst expectations. Be cautious following this line of thinking. You also need to look at the quality of those earnings. That is a better gauge of future earnings performance. Firms with high-quality earnings typically generate above-average earning ratios. They also tend to outperform their competitors and often the market overall. High-quality earnings provide reassurance and confidence in the company's future growth potential. So how do you identify quality earnings? When analyzing quarterly reports, look for the contributing factors that may not be sustainable or repeatable. For example, did the great earnings come from the sale of an investment or sale of some unproductive asset? Did the earnings come from a one-time or fortuitous event that would most likely not be repeated? These and other questions will provide you insight into whether these earnings represent sustainable operations that will continue to produce strong earnings. Sales growth and cost-cutting are the best routes to high-quality earnings, and they can be replicated over time. A company that demonstrates sales growth often sustains that growth momentum into the future. Similarly, a management team that demonstrates an ability to contain cost will usually continue to do that over time. This is the kind of company you are seeking, a well-run organization, with a well-received product or service offering a good customer relationship. This tends to generate a strong sales, profit, and cash flow performance. There are many factors affecting earnings that are beyond a company's control. You are seeking insights into whether this company can continue to replicate their performance in the future. Is this a temporary boost, or do these earnings represent a quality advance due to sales growth or cost reduction? We talked about operating cash flow EPS. The highest quality earnings go straight to the bank. Try to identify firms that generate net cash similar to their earnings growth. That is an indicator of genuine financial strength and quality. Most companies, however, must wait before they can deposit revenues in the bank. Accounts receivable are a form of necessary loan to customers. The best companies aggressively manage and minimize their receivables to sustain a strong cash flow. Remember, accounting practices can manipulate earnings, but cash is counted. When a company that you are following reports their quarterly results, look to those earnings to compare analysts' estimates. An upside surprise usually causes the stock price to rise. Likewise, if earnings disappoint analysts' estimates, the stock price is typically punished. Even a strong set of quarterly results can trigger a stock price decline if they fail to meet or exceed analysts' expectations. This can result from an issue at the company, or an issue with the analyst's forecasted expectations. Most analysts are quite accurate, others are notably less skilled, and analysts' estimates can be inaccurate for a variety of reasons. Forecasting. Projecting earnings is not easy. Businesses are subject to many forces that impact their earnings. Analysts' forecasts are hobbled by only having publicly available information. It is not realistic to expect flawless estimates from analysts. These are estimates. Analysts, like the rest of us, are subject to being influenced by our peers. Research shows that analysts tend to make earning predictions that do not differ greatly from the majority of their peers. They do not wish to be proven wrong, or if they do, they would like to be proven wrong along with everyone else. We are all subject to what psychologists call herding behavior, but as investors, we know the crowd is not always correct. Analysts have somewhat of a built-in bias towards over-optimism. Most forecasts err on the high side. Often, as the years progress, analysts revise their rosy forecasts downward as the company reports performance results and other factors become apparent. Some analysts tend to stay positive to keep themselves in good graces with the company to assure their continued access to management and the insights that it brings. They are also encouraged by their brokerage house employers to remain optimistic to encourage investor clients' interest in investing in stocks. For these and other reasons, the advantage of doing your own analysis should seem apparent. So, to sum up, earnings per share are an important factor in investment research, but you must keep in mind that it can vary widely with how earnings and shares outstanding are determined themselves. Accounting practices enable considerable flexibility in what is used to calculate EPS. You must be diligent in your research and clearly understand the numbers you are looking at, and whether you intelligently conclude these numbers represent a basis for future growth in earnings expectations. You too can invest knowledgeably. These videos are designed to help you build your investment knowledge and skills. Develop and understand your investment goals, your plan, and then choose your investments carefully and prudently in keeping with your plan and with the knowledge you gain from these videos. Thanks again.